I'm about to save you thousands of dollars on your taxes. On July 4th, 2025, President Trump signed the One Big Beautiful Bill Act. And hidden inside is a $6,000 tax deduction just for seniors. That's $6,000 per person every year. And if you're married, that's $12,000. But here's the catch. Most seniors have no idea this exists. And if you don't claim it correctly, you'll miss out on the biggest tax break of your lifetime. Today, I'm going to show you exactly how to get your money from the One Big Beautiful Bill. Plus, I'll reveal 3 other massive tax breaks hidden in this bill that nobody's talking about. Let me hit you with some numbers that will blow your mind. Before this law, a married couple over 65 got $3,200 in standard deductions. Now, $46,700. That's right, $46,700 in deductions for doing absolutely nothing except being 65 or older. Here's what that means in real money. A couple making $100,000 a year just got a $1,720 tax cut. That's a free vacation every single year. A single senior making $60,000, you just saved $720. That's 2 months of groceries gone from your tax bill. But wait, it gets better. 88% of Social Security recipients will now pay 0 federal tax on their benefits. Let me repeat that. 88%. If you're on Social Security, you probably just became tax-free. Think about what this means. The average Social Security benefit is $1,027 per month. That's $2,124 per year. Before this law, many seniors paid taxes on up to 85% of those benefits. Now, most pay nothing. 0. Zilch. Nada. That's hundreds or even thousands of dollars staying in your pocket instead of going to the IRS. Now let's break down exactly how this works. The new law gives you a $6,000 senior bonus deduction. This is on top of everything else you already get. Here's the breakdown for 2025. If you're single and over 65, standard deduction, $15,700, extra senior deduction, $2,050, new bonus deduction, $6,000, total, $23,750 if you're married, both over 65. Standard deduction, $31,300, extra senior deduction, $3,400, new bonus deduction, $12,000, total, $46,700. And here's the beautiful part. You don't need to itemize. You don't need receipts. You don't need to hire an expensive accountant. You just claim it. It's that simple. Let me show you exactly how this appears on your tax return. When you file your 2025 taxes next year, there will be a new line on Form 1040. It's called Senior Bonus Deduction. You literally just write $6,000 if you're single, or $12,000 if you're married filing jointly. That's it. No special forms, no documentation needed, no proof required. Just be 65 or older and have a valid Social Security number. But there's always a catch, right? Here it is. If you make too much money, the deduction phases out. For single filers, full $6,000 if you make under $75,000. Starts phasing out at $75,000. Completely gone at $175,000. For married couples, full $12,000 if you make under $150,000. Starts phasing out at $150,000. Completely gone at $250,000. Now, if you're thinking, I make more than that, don't tune out. I'm about to show you legal strategies to get under these limits. Because here's what most people don't realize. It's your taxable income that matters, not your total income. And there are ways to reduce that number. Let me give you a real example. John and Mary are both 67. They have $40,000 in Social Security benefits, $65,000 in pension income, $20,000 in IRA withdrawals. Total income, $125,000. They think they qualify for the full $12,000 deduction. But wait, not all of that counts toward the limit. Only $34,000 of their Social Security is taxable. So their taxable income is actually $119,000. They're safely under the $150,000 limit. They get the full $12,000 deduction. Now, if you live in a high-tax state, sit down for this next part. The SALT deduction, that's state and local taxes, just quadrupled. It went from $10,000 to $40,000 for married couples, $20,000 for singles. If you own a home in New York, California, New Jersey, or any high-tax state, you just got a massive tax break. Let me show you the math. Say you pay $15,000 in property taxes and $10,000 in state income taxes. Before, you could only deduct $10,000. You lost $15,000 in deductions. Now, you can deduct all $25,000. That's $15,000 more in deductions. In the 24% tax bracket? That's $3,600 in tax savings. $3,600 every year through 2029. But here's where it gets really interesting. The SALT deduction increase has a special rule for seniors. If you're over 65, you can carry forward unused SALT deductions for up to 3 years. What does that mean? Let's say you pay $30,000 in property taxes, but only have $50,000 in income. You might not benefit from the full deduction this year, but you can save it and use it next year when you take a big IRA withdrawal. This is huge for tax planning. But here's something that's getting zero media coverage. The estate tax exemption just became permanent at $15 million per person, $30 million for married couples. It was supposed to drop to $7 million in 2026. Now it's locked in forever. If you're thinking, I don't have $15 million, this still matters. Here's why. With inflation, your house, retirement accounts, and life insurance, many middle-class families are hitting these limits. Let me break this down with real numbers. Say you bought your house in 1985 for $150,000. Today it's worth $1.2 million. Add your 401k, $800,000, your IRA, $500,000, life insurance, $1 million, some stocks and savings, $450,000, total estate, $3.95 million. That's getting close to the old $7 million limit for a couple. But now you have plenty of breathing room. This change means you can pass everything to your kids. Tax-free. Forever. No more selling the family farm to pay the IRS. No more liquidating the family business. Your legacy is protected. All right, let's talk strategy. How do you squeeze every penny out of these new rules? Strategy number 1. Time your income. If you're near the phase-out limits, control when you take income. Here's a specific example. Bob is 68 and single. His income sources: Social Security, $30,000, partly taxable. Pension, $45,000. IRA required minimum distribution, $15,000. His taxable income would be about $75,000, right at the phase-out threshold. Solution: convert some traditional IRA money to Roth IRA this year while he still gets the full $6,000 deduction. Next year, his RMDs will be lower, keeping him under the limit. Strategy number 2. Bunch your deductions with the higher SALT cap. Consider prepaying property taxes in December, paying Q4 state estimated taxes early, bunching charitable donations in high-income years. Real example: if you normally give $5,000 per year to charity, consider giving $15,000 every third year instead. This maximizes your deductions in years when you have higher income. Strategy number 3. The car loan hack. Here's one nobody's talking about. The bill includes a $10,000 car loan interest deduction, but only for American-made vehicles. Buying a car? Finance it and deduct the interest. That's up to $10,000 in additional deductions. Let me show you the math. You buy a $40,000 American-made SUV, finance $30,000 at 6% interest. First-year interest, about $1,800. That $1,800 comes right off your taxable income. In the 22% bracket, that's $396 in tax savings. Not huge, but every dollar counts. Strategy number 4. Stack your benefits. Remember, all these benefits stack. $6,000 senior deduction, higher SALT deduction, car loan interest, charitable deduction, now $2,000 for non-itemizers. A savvy senior could easily add $20,000 plus in deductions. Here's a real-world example of stacking. Margaret, age 70, single. Senior bonus deduction, $6,000 property taxes, New York, $12,000, state income taxes, $6,000, charitable giving, $2,000, car loan interest, $1,500, total additional deductions, $27,500 at a 24% tax rate. That's $6,600 in tax savings. Strategy number 5, the healthcare triple play. Here's something most people miss. If you're not on Medicare yet, age 65 to 66, you might qualify for premium tax credits for health insurance, HSA contributions, if you have a high deductible plan. The senior bonus deduction. Stack all three, and you could save thousands. Now, I need to be honest with you. This law isn't all sunshine and rainbows. It costs $5 trillion over 10 years. The national debt is exploding. Social Security now goes broke in 2032 instead of 2033. Even Elon Musk called it the debt slavery bill. And here's what really bothers me. The poorest seniors, those making under $30,000, get almost nothing. They already pay no taxes, so a deduction doesn't help. Meanwhile, someone making $149,000 gets the full benefit. Is that fair? You decide. But there's another problem nobody's discussing. These changes are temporary. The senior deduction? Gone after 2028. The higher SALT cap? Back to $10,000 in 2030. Only the estate tax change is permanent. This creates a tax planning nightmare. You need to maximize benefits now before they disappear. Here's what smart seniors are doing. They're accelerating income into the 2025-2028 window, taking larger IRA withdrawals while the deductions are high, then living on Roth IRA money after 2028 when deductions shrink. It's called deduction arbitrage, and it could save you tens of thousands. Let me walk you through the timeline. 2025. New deductions take effect. Claim them on your 2025. Return filed in 2026. 2026, full benefits continue. This is the sweet spot year. 2027, still full benefits, but start planning for the phase-out. 2028, last year of senior bonus deduction. Consider accelerating income. 2029, senior deduction gone, but SALT cap still elevated. 2030, everything reverts to old law except estate tax. Mark these dates on your calendar. Work with your tax professional to create a multi-year strategy. The seniors who plan ahead will save the most. Here's your action plan. Step 1. Calculate your 2025 income. Add up. Social Security benefits. Use SSA 1099. Pension income. Use 1099-R. IRA withdrawals. Planned for 2025. Investment income. Dividends and interest. Any part-time work income. Write down the total. Step 2. Check your eligibility. Are you under the income limits? Single. Under $75,000 for full deduction. Married. Under $150,000 for full deduction. If you're close, can you reduce income to qualify? Consider delaying IRA withdrawals, using Roth conversions strategically, maximizing pre-tax 401k contributions if still working, donating IRA funds directly to charity. Step 3. Adjust your withholding. This is crucial and nobody talks about it. File a new W-4P with your pension provider. Reduce quarterly estimated taxes. Keep more money in your pocket now. Why wait for a refund when you can have the money today? Step 4. Plan for 2026-2028. Remember, this is temporary. Create a spreadsheet showing income for each year. Identify opportunities to shift income between years. Consider Roth conversions while deductions are high. The senior deduction expires in 2028. The SALT cap goes back down in 2029. Front-load your benefits while you can. Step 5. Get professional help. This is complex stuff. A good tax pro can save you thousands. The consultation pays for itself. Look for an enrolled agent or CPA who specializes in senior taxes. Ask them specifically about the new senior bonus deduction, SALT cap strategies, multi-year tax planning, Roth conversion opportunities. If they don't know about these changes, find someone who does. Let me bottom line this for you. If you're 65 or older, you just got a massive tax cut. Typical savings. Single senior, $720, $1,000 per year. Married couple, $1,720, $3,000 per year. High tax state owners, up to $5,000 per year. Over the next 4 years, that's $10,000 to $20,000 in your pocket. Dollars in your, but only if you claim it. And only if you plan correctly. The clock is ticking. This is temporary. Don't leave money on the table. One final thought. I've been helping seniors with taxes for over 20 years. I've never seen a tax break this big for retirees. But I've also never seen one this complicated. The phase-outs, the timing, the stacking of benefits, it's a lot to figure out. That's why I created this video. Because every senior deserves to benefit from this law. Not just the wealthy ones who can afford expensive tax advisors. If this video saved you money, do me 3 favors. First, share it. Every senior needs to know about this. Second, subscribe. I'll keep you updated on changes. Third, comment. Tell me how much you'll save. And remember, the IRS isn't going to tell you about this deduction. Your tax preparer might not even know about it yet. But now you do. And knowledge is money. Go get your $6,000. You've earned it. In my next video, I'll show you 5 more hidden tax breaks in this bill that could save you thousands more, including one that lets you deduct your grandchildren's college tuition. See you there.